Hey everyone, Lou Elson here, your trusted real estate advisor. Today, we're diving into the murky waters of mortgage myths. There's a ton of misinformation floating around, and it can seriously impact your home buying journey. Today, we're busting not 3, not 5, but 7 of the biggest myths out there. These misconceptions can cost you time, money, and even prevent you from achieving your dream of home ownership. So let's bust these myths wide open. Myth number 1, you can't overcome bad credit. Our first myth is a big one. If you have a bad credit, you can forget about buying a home. This simply isn't true. While a good credit score is definitely beneficial, it's not the be-all and end-all. Let's quickly define what a credit score is. It's a 3-digit number that summarizes your credit history. It tells lenders how reliably you repaid debts. Scores typically range from 300 to 850. Higher scores generally mean better interest rates on loans. Now, even if you have a less than perfect score, there are still options. One late payment won't ruin your chances forever. The key is to establish good financial habits, make on-time payments going forward, and work to improve your score over time. Even a bankruptcy doesn't permanently bar you from home ownership. There are programs and strategies to help you rebuild your credit and get you on the path to buying a home. It's also important to know that your credit score isn't set in stone. It can change month to month, so don't get discouraged. Myth number 2, lenders will nickel and dime you with fees. Many people worry that lenders are constantly trying to squeeze extra money out of them through hidden fees. While it's true there are costs involved in getting a mortgage, reputable lenders are transparent about these charges. It's important to understand the difference between lender fees and third-party fees. Many of the costs associated with the mortgage actually go to third parties for services like the appraisal, home inspection, and credit report. The lender acts as the facilitator, but they aren't pocketing all that money. You'll receive a loan estimate early in the process, which outlines all the estimated costs. Then, you'll get a closing disclosure before closing, which provides the final, detailed breakdown. If there were any overcharges up front, they'll be credited back to you on the settlement sheet. Transparency is key, so don't hesitate to ask your lender to explain any fees you don't understand. Myth number 3, you need 20% down in cash. This is perhaps the most common mortgage myth. You need a 20% down payment in cash to buy a home. This simply isn't the case for many loan programs. Several loan programs require significantly less than 20% down, sometimes as low as 0 to 3.5%. Government-backed loans like FHA, VA, and USDA are specifically designed to make home ownership more accessible. There is even some conventional loans that have 3 and 5% down payments. FHA loans, for example, often require as little as 3.5% down. VA loans are available to eligible veterans and often require 0 down. USDA loans are for rural and suburban homeowners and also have low to no down payment options. While a larger down payment can reduce your monthly payments and overall loan costs, it's not always a requirement to get started. Imagine you're a first-time homebuyer who puts off your search for years trying to save up while home prices are rising. This is a perfect example of how these myths can hold back people from building equity. Myth number 4, the interest rate is the only thing that matters. This is a trap. Some buyers could fall into it. While the interest rate is a huge factor, it doesn't tell the whole story. The key figure you should really be looking at is the APR, or annual percentage rate. The APR includes the interest rate, but it also rolls in most of the lender's fees and other costs associated with the loan, like origination fees or discount points. This gives you a more accurate picture of the total cost of borrowing. A loan with a slightly higher interest rate but much lower fees could actually have a lower APR, making it the cheaper option over the life of the loan. Always compare the full loan estimates from different lenders, not just the advertised interest rates. Myth number 5, you must have a traditional 9-to-5 job. Our myth number 5 is very relevant in today's world. You need a stable, long-term W-2 job to get a mortgage. This can be a huge source of anxiety for freelancers, small business owners, and gig economy workers. but the reality is, it's a myth. Lenders understand the nature of work has changed. While having a traditional salary makes the income verification process simpler, it's not a requirement. If you're self-employed, lenders will typically ask for 2 years of tax returns and profit and loss to verify a stable and ongoing income stream. They want to see consistency. As long as you can document your income and show that it's reliable, your dream of home ownership is just as attainable as it was for someone with a W-2. Myth number 6. Pre-qualification and pre-approval are the same thing. This is a big one that can cause major confusion. These two terms sound similar, but in the real estate world, they are worlds apart. A pre-qualification is a quick, informal estimate of how much you might be able to borrow. It's often based on information you provide verbally, without any verification. Think of it as a ballpark figure. A pre-approval, on the other hand, is a much more powerful tool. This is a formal process where a lender thoroughly vets your financial background and pulls your credit, verifies income, and checks your bank statements. A pre-approval is a conditional commitment from the lender to give you a loan up to a certain amount. In a competitive market, an offer with a pre-approval letter is taken far more seriously than one with just a pre-qualification. Myth number 7. You should max out your approved loan amount. And our 7th myth for today: if the bank approves you for a $500,000 loan, you should shop for a $500,000 home. While certainly not always true, this could potentially lead to feeling house poor. Remember, the bank is looking at your numbers, your income, and your debts to determine the maximum they are willing to risk on you. They aren't factoring in your lifestyle. They don't know about your plans for travel, your kids' college funds, your car maintenance costs, or your desire to eat out once in a while. Just because you can get a loan for the amount doesn't mean that you should. The smart move is to create your own budget first. Decide what monthly payment you're truly comfortable with, then work backwards to determine your ideal home price. Use your judgment alongside a pre-approval to determine a comfortable home price. The best way to navigate the mortgage process is to get pre-approved. This gives you a clear picture of what you can afford and helps you avoid falling prey to these common misconceptions. So, let's recap the truths. Your credit can be repaired. Lender costs are transparent. You don't always need 20% down. The APR is more important than the interest rate. Your non-traditional job doesn't disqualify you. Pre-approval is your golden ticket. You should set your own budget. Don't let these myths prevent you from achieving your homeownership goals. If you have any questions about mortgages, home buying process, or anything real estate related, don't hesitate to reach out. You can find my contact info on the screen. And I'm here and happy to help you navigate this exciting journey.